Let's discuss few questions on revenue from contracts from customers. First question. ABC operates a catering service that specializes in business luncheons for large corporations. ABC requires customers to place their orders 2 weeks in advance of the scheduled events. ABC bills its customers on the 10th day of the month following the date of service and requires that payment to be made within 30 days of the billing date. Conceptually, ABC should recognize revenue from its catering services at the date when. So basically, they are asking us on which date ABC should recognize the revenue. So when revenue should be recognized? Revenue should be recognized when performance obligation is fulfilled or satisfied. In this case, what is the performance obligation of ABC? The performance obligation of ABC is to serve the lunch on the date in which the event is scheduled. So, when luncheon is served, performance obligation of ABC Limited is satisfied. So, they can recognize revenue on the date in which the lunch is served. So that makes option B to be the right answer. So whether cash is coming in or cash is going out, whether we have billed them or not, all those things are irrelevant. If performance obligation is satisfied, revenue can be recognized. Second question. A software developer enters into a contract with a new customer to sell a software license and perform installation services. The entity sometimes sells the license and installation services separately. So the software license can be sold separately and installation services can be sold separately. So they are two distinct different products. The installation service is routinely performed by other entities and does not significantly modify the software, which means sometimes the customer purchases the software license from us, but they get the installation services done by other entities. The entity historically provided to new customers technical support for a 5-year period for no additional consideration. So to the new customers, the company has a practice of providing technical support for a period of 5 years, and for this technical support, no additional consideration is charged. The contract does not specify the terms or conditions for the technical support services. So nothing specifically mentioned about technical support services in the contract. According to the revenue recognition principle governing contract with customers, which of the following represents performance obligation identified by the entity in this contract? So how to identify a performance obligation? Performance obligation should be distinct. When we say distinct, the customer, it should mean it should be the product should be able to do the product should be able the company should be able to sell the product separately, or the company should be able to sell the services separately, and the customer should be able to derive some benefit out of it without depending on other products provided by the company. To put it very simple, in this case, we have three types of uh, services or products offered by the company. First, the software license. Then we have installation services. Then we have technical support. Can we say whether the license is a can we say whether the license is separate performance obligation? Yes. Why? Because it can be sold separately and the customers can derive some benefit out of it. Is installation service is a separate performance obligation? Yes, because installation services can also be sold separately without, I mean, it is not necessary that if a customer is purchasing license from us, he should get installation services also done by us. No, it is not necessary. He can get the installation services done by other entities, or he can also get the installation services separately from us. So installation services is also a distinct service that can be provided. So it can be sold separately. So that is also a different performance obligation. Now coming to technical support, obviously it is a separate performance obligation. For all the new customers, we are providing a 5-year, we are providing technical support for a 5-year period, which is a separate performance obligation. So in this case, all three, that is license, installation service, and technical support, are separate performance obligations. So that makes option C to be the right answer. Third question. An entity enters into a contract with a customer to sell products X, Y, and Z in exchange for $250,000. Control over the products will be transferred to the customer at different points in time. The entity determines that delivery of each product is a distinct performance obligation. Product X and Y are regularly sold separately, and their standalone selling prices of $40,000 and 1,20,000 respectively. So here the company is going to sell three products, X, Y, and Z, and selling on sale of all these three products or separate performance obligations. And if X is alone, I mean, all the three products can be sold separately. If X is alone sold separately, it can be sold for a price of $40,000. And if Y can be sold separately, it can be sold for a price of 1,20,000. And if Z is sold separately, here it is mentioned. The selling price of X and Y is directly observable, but the standalone selling price of product X of $1,60,000 was estimated using the adjusted market assessment approach. So for product X, the selling price is 1,60,000. So when we add all these three, we get $3,20,000. The entity determined that discount provided to the customer does not relate to one or more specific products in the contract. What revenue, actually this is the requirement of the question. What revenue will be recognized by the entity on the sale of the product? So here first, they are talking something about discount. So how to calculate, or what is the discount provided by the company to the customers in this case? If product X, Y, and Z are sold separately, they can be sold for these prices and the total amounts to $3,20,000. But here, when product X, Y, and Z are sold, when they are sold together, it is sold for a price of $2,50,000. So if they are sold separately, it could have been sold for 3,20,000. But if they are sold in a bundle, it is sold for 2,50,000. So there is a $70,000 discount that is given. But the question clearly says the entity determined that discount provided to the customer does not relate to one or more specific products in the contract. So this $70,000 of discount should be allocated to product X, Y, and Z. It is not that the 70,000 does not apply to specifically one product. It is for all the three products. Now, on what basis this $70,000 should be, on what basis the $70,000 should be allocated? It is based on the standalone selling prices of the product. So the total is 3,20,000. If they are sold separately, the total is 3,20,000. The product X alone can be sold for $40,000 into 70,000. So this gives us the amount of discount that is applied for, or that should be allocated for product X. So 40,000 by 3,20,000 into 70,000, we get 8,750. So this is the amount of discount that should be allocated to product X. But what is the requirement of the question? What revenue will be recognized by the entity on the sale of product X? So the total, if product X alone, if it is sold separately, it could have been sold for 40,000. But if we are selling it in a bundle, discount is offered, which is totally it is 70,000. Out of the 70,000, 8,750 is allocated to product X. So 40,000 minus 8,750, we get 31,250. So that makes option C to be the right answer. So if it is sold separately 40,000, but because of selling it in a bundle, there's a discount of 8,750 that is allocated to X. So 31,250 is the right answer. Fourth question. Which of the following is not a criterion that must be met for a contract with a customer to be accounted for under revenue recognition standard? Option A says the contract must have a commercial substance. It is one of the conditions that must be met for a contract with customer for revenue recognition. So option A is not the right answer because that is one of the conditions. The question is asking which one of the following is not a criterion. The payment terms can be identified. Again, that is also one of the criteria for a contract with a customer. Option D says each party's rights regarding goods or services to be transferred can be identified. Even that is one of the criteria. But option C says the cost to fulfill the contract or expected to be recovered. No, it is not one of the criteria, but actually there are four criteria for that must be met for a contract with a customer. Three is given. One is the contract should have a commercial substance, payment terms can be identified, and the right of each parties can be identified. One more condition that is missing in this is it should be probable that or it is probable that you are going to collect cash from your customers. So that is one of the criterion which is missing over here. So the fourth criterion is it should be probable that you are going to collect cash from your customers for the goods or services provided. So here option C is the right answer. It is not one of the criterion for a contract with a customer. Question number 5. After a successful promotion aimed at members of a specific national association, Gorham Publishing Company received a total of $90,000 for a 3-year subscription to a monthly publication beginning April 1, 2015, and properly recorded this consideration received in the contract liability account. So what they are saying is, so today they have received $90,000 for a service that is going to be offered over a period of 3 years. So it's a 3-year subscription to a monthly publication. So uh, every month we are going to fulfill the performance obligation. So if it is for a 3-year period, 3 year has how many months? So 90,000 divided by 36. So 90,000 divided by 36, we get $2,500. So every month we should recognize a revenue of $2,500. Now, on which date this $90,000 is received? This $90,000 is received on, it is not mentioned, but let's say the date on whatever we are receiving this $90,000. What is the journal entry we have to pass? We have to pass the journal entry cash account debit. Why we are debiting cash? Because cash is coming in. Debit what comes in? So cash debit 90,000. And what we have to credit? Cash account debit to contract liability account 90,000. Here, why we are crediting a liability? Because we have received the cash, but we have not provided any services to the customers so far. So the date on which cash is received, this is the journal entry that needs to be passed. Now, as we fulfill our performance obligation, we recognize a revenue of 2,500 rupees every month, and that will decrease the value of the contract liability. Now, reading further, assuming Gorham records adjustments only at the end of the calendar year. Okay, so it clearly says that uh, the adjustment entry is made at the end of the year, but not at the end of every month. The adjusting entry required to reflect proper balance in the accounts on 31st December 2015 would be how much? So here, the service, we started to provide the service from 1st April 2015. And the year end is 31st December 2015. So during this 9 months period, service is provided or performance obligation is satisfied, which means we can recognize revenue for this 9 years period, right? So, sorry, not 9 years, for this 9 months period, we can recognize revenue because performance obligation is satisfied. So totally $90,000 is received, for which the performance obligation is going to be satisfied over a period of 36 months, which is nothing but 3 years. So every month, 2,500 dollars of revenue can be recognized. So for every month, if you can recognize $2,500 of revenue, if you can recognize $2,500 of revenue for 1 month, then for this 9 months period, what is the amount of revenue that you could have recognized? We could have recognized the revenue worth of 2,500 into 9. So we get $22,500. Now, what is the journal entry for this? We will debit the contract liability in this case. Why contract liability will be debited? Because performance obligation is satisfied. So liability is reducing by how many dollars? By $22,500. And what we will credit? We will credit revenue here. Why? Because performance obligation is satisfied. So performance obligation is satisfied for 9 months period. So for that 9 months period, you can recognize the revenue of $22,500. So that makes option D to be the right answer. Debit contract liability for 22,500 and credit subscription revenue for 22,500. So at the end of the year, we will have a balance of, let's say, at the beginning of the period, we have 90,000 as a balance in the contract liability. Now 22,500 is reduced. So at the end of the year, we will have a balance of $67,500 in the contract liability account. Question number 6. On October 1, year 1, company A sold 1 lakh gallons of product X to company B at $3 per gallon. 50,000 gallons were delivered to company B on 21st December year 1 and the remaining quantity was delivered to company B on 8th January year 2. So on 1st October year 1, company A sold 1 lakh gallons of product X to company B. But out of that, 50,000 gallons were 50,000 gallons were sold to B on December 21 and remaining 50,000 were sold on January 8, 2000, on January 8, year 2. Payment terms are 50% due on October 1, year 1 and 25% is due on first delivery and 25% is due on second delivery. What amount should company A accrue as revenue related to this transaction on 31st December year 1? So here they have given the collection pattern, that is 50% on the date of entering into the contract and 25% on first delivery and 25% on second delivery. But the cash collection pattern is irrelevant here. They are asking when revenue should be recognized or how many rupees of revenue should be recognized. We should recognize revenue to the extent of performance obligation satisfied. So if the contract is to sell 1 lakh gallons of product X, actually how many gallons of product X is sold? 50,000 gallons were sold on 21st December year 1. Remaining 50,000 is sold on January 8 year 2. Their requirement of the question is how much rupees of revenue can be recognized on 31st December year 1. So till 31st December year 1, how many gallons are sold? Only 50,000 gallons are sold. Remaining 50,000 is sold in the next year. That is January 8 year 2. So we can recognize revenue for this 50,000 gallons. Each gallon is sold for $3. So one revenue worth of $150,000 can be recognized at the end of the first year. That makes option B to be the right answer. So again, whether cash is coming in, whether the customer has paid the cash or not, all those things are irrelevant. If performance obligation is satisfied, recognize revenue or recognize revenue to the extent of which performance obligation is satisfied. In this case, 50,000 gallons are sold in the first year. So we will recognize revenue for this 50,000 gallons in the first year. Remaining 50,000 gallons are sold in the second year. So for that 50,000 gallons sold in the second year, revenue will also be recognized in the second year. Seventh question. An entity that owns a new professional basketball team sells season tickets to its team's games. The first season lasts from November year 1 through April year 2. So how many months? So it is November, December, January, February, March, and April. So it is a 6 months period. And each month, 10 games are going to be played by the team with 10 games played each month. In year 1, the entity collected $3 million from advance season ticket sales. So this $3 million is collected in year 1 itself. But the performance obligation is going to be satisfied over a period of time. Its fiscal year end contract is 31st. Sorry, its fiscal year end is 31st December. So this is the year end. Based on this information, the entity should. So how many rupees of income they should, actually how many rupees of revenue they should recognize in year one income statement. That is what we need to calculate. So here, totally how much rupees they have collected? They have collected $3 million. So even though they collected this $3 million in advance, for this $3 million, the revenue is going to be, sorry, for this $3 million, uh, the performance obligation is going to be satisfied over a period of 6 months. First, what is the performance obligation? Playing matches is the performance obligation, right? So this performance obligation is going to be satisfied over a period of 6 months. So 3 million divided by 6 months. So we get $5 lakh. So this $5 lakh is the revenue that can be recognized each month. So when the season is going to start, the season is going to start in November and it is going to happen till April. The requirement of the question is the fiscal year end of the company is December 31. So based on this information, how many rupees of revenue the company should recognize in year one? That is till December. What is the amount of revenue that can be recognized by the company? So $5 lakh per month. Right. So every month they can recognize revenue up to $5 lakh. So in November, they can recognize a revenue of $5 lakh. And in December, they can recognize a revenue of another $5 lakh. So that makes totally during the first year, the company can report a revenue of 10 lakh in its income statement. So that makes option C to be the right answer. Report a revenue of 1 million on its year one income statement. So option C is the right answer. When the company will recognize revenue for January, when the 10 matches are played in the month of January. When the company will recognize revenue for the month of February, when 10 matches are played. So similarly in March and April as well. So during the first year, totally 20 matches are played. That is 10 in November and 10 in December. So performance obligation is satisfied for these 2 months. So revenue is also recognized for the 2 months period. That is 5 lakh into 2. We get 1 million. Question number 8. On July 15, a company entered into a 3-month agreement to rent a mission. The company needed to complete a special order. The mission would be delivered on August 1 and rental payments are due on the first day of each rental month. So when the company is going to get the mission, it is on August 1. So from when on they are going to start, uh, from when they are going to pay the interest, sorry, from when they are going to pay the rent, it is going to be, the company is going to start paying the rent on first day of each rental month. That is 1st of August, they will pay the first rent. Then again, 1st of September, they will pay the rent. So similarly, at the beginning of each month, they are going to pay the rent. The effect this event would have on the company's July 31 financial statement would be what? So let's look from here. Increase liabilities and decrease income. So here, actually, there is no increase in the liability and decrease in income. Because why there is no decrease in income? Because the company is going to pay the rent in the month of August. The requirement is what is the impact of this transaction on 31st July? On 31st July, no rent is recognized, no rent expense is recognized. So obviously, it is not going to decrease the income of the company. And where there is an increase in liability, there is no liability for the company here. So option D is not the right answer. Increase both assets and liabilities. Obviously, there is going to be no impact on liability. Is there any increase in asset? No. Why? Because here, the machine would be delivered on August 1. So as of 31st July, the company does not have any asset. So there is going to be no increase in asset or liabilities as well. Increase both assets and income. Again, just now we discussed there is no increase in asset because the company is going to take the delivery of the machine on August 1. So on 31st July, the company does not have the machinery. And is there going to be any increase in income? Obviously, no. Here, in fact, the company is renting the machine. So they have to pay the rent. So there is going to be no increase in income as well. It causes no change in assets, liabilities, or income. So that is the right answer. Because of this transaction, there is going to be no impact because the machinery would be delivered on August 1 and rental payments are going to be on the first of each month. So there is going to be no impact on the balance sheet as well as on the income statement. So that makes option A to be the right answer.